It's very hard to lift the market when you have trillion, $2 trillion, $3 trillion companies that are now starting to roll over. So I continue to be on the case, and I've been consistent. If there's one thing it's been consistent that you will see inflation stay around 3% and the economy is going to start to have trouble. And we are seeing the lag effect of monetary policy, which is 6 to 12 months lag, starting to take more and more a bite out of the markets. In addition, we'll talk about the dollar yen. The dollar yen is now in a precarious spot because of the yield curve control loosening that the Japanese central bank is doing. And there's lots of issues.
The U.S. dollar strengthened on Thursday, supported by higher U.S. Treasury yields. Inflation data from the U.S. indicated an acceleration in the Consumer Price Index, CPI, rising from an annual rate of 3% to 3.2%. However, this figure fell slightly below the market expectation of 3.3%. Another economic report revealed an increase in initial jobless claims to 240,000, surpassing market estimates of 230,000. The U.S. dollar index rose above 102.50, marking the highest daily close in a month, although it remains below the 102.80 resistance level. U.S. Treasury yields surged, with the 10-year reaching 4.1% and the 2-year at 4.84%. Stocks on Wall Street finished slightly higher, supported by expectations that the Federal Reserve won't raise interest rates further. Gareth Soloway in this video discusses the CPI, PPI, dollar strength, and other various global indicators. He also analyzes the charts and describes key zones that should be paid attention to. Let us now get into the video. And don't forget to like, subscribe, and drop your comments below.
Yesterday, we had the CPI data coming out. Now, the CPI data, Consumer Price Index, came in slightly better than expected, ever so slightly. I want to jump over to this screen right here. Yesterday, the S&P 500 opened higher on that better than expected CPI data. It rallied up. This is the 10-minute chart. So each of these candles is 10 minutes long. We saw a beautiful move to the upside, but then look at what happened the rest of the day. The markets collapsed back down. When I see price action, when you see good news and the markets initially react well and then roll over, that's actually a bearish sign. It means that even with good news, there's institutional sellers that are pounding down the market. All right, so that's important to recognize. That was bearish. I even posted on Twitter yesterday that is not a good sign. It's bearish to see gains, especially on a low volume-ish type afternoon, get wiped out with the market selling. Okay, so let's go back here. Let's talk about the PPI data. The PPI data came in this morning. That's Producer Price Index. And the Producer Price Index basically means it's on the producer side. All right, that's the inflation. So consumer, that's what you and I are paying at the store, the consumer, the CPI. The producer is what the people that are producing the goods are seeing with inflation. Well, guess what? The CPI today came out slightly hotter than expected. All right, month over month, 0.3% versus estimates at 0.2%. Year over year was also 1/10 hotter than expectations. What does this mean? Well, to break it down simply, it means that on the producer side, inflation is starting to uptick. And we can jump over here, folks. You can take a look at what this says over here. All right, you can see the headline here on Market Watch. PPI shows sharpest rise since January in U.S. headline wholesale prices. All right, U.S. wholesale prices pick up in July, PPI shows. All right, now, just to explain what this is telling us, this is telling you exactly what I've been predicting now for the last 6+ months, that inflation is going to get sticky above 2%, right around 3%. That is your bogey level right now. So my guess is we're going to hover around 3% for the next 6 months, let's say, and that's going to make it very hard for the Federal Reserve to ultimately cut interest rates and print money. And why? You might say, well, who cares about that? The economy's strong. Well, sure, the economy right now is strong, but if inflation remains at 3% or greater, what happens when we do hit a recession? Whether it's in 3 months, 6 months, a year, 5 years, what happens if that inflation is higher? The Fed is going to be handcuffed. And that is going to put this economy in a tricky spot, especially the stock market, that valuations are absolutely insane. Speaking of which, I wanted to show you guys this chart. This is a chart of the NASDAQ composite. And the reason I'm bringing this up, and this might be a little hard to see, but we're going to try to show it here. So this is the chart of the NASDAQ and the .com. The run up, the pullback, and I showed this kind of a couple days ago, but look at that run up, look at the pullback, and look at the big bounce, almost back to the highs on the NASDAQ. Now, if we go back here, right, we slide this chart over here, it's very similar. Sharp run up, pullback, almost back to the highs. And then again, the idea here is that I think we're going to start rolling over and coming back in. And by the way, nothing goes in a straight line. So you shouldn't expect the markets to ultimately go straight down. I don't think we're going to go back to the October lows anytime soon. But I do think now you're going to stair step down, small bounce, down, small bounce, and eventually test that level. And you can already see it, right? We know Apple's earnings came out. They were a little bit on the disappointing side here. So if we bring up that daily chart on Apple, we can already see that we've broken some key support levels here. Here was a beautiful upsloping trend line. Look at the waterfall down. You've now started to consolidate here, which means you're likely going lower on Apple. So Apple, the biggest market cap company in the world, basically $3 trillion, has now broken its upward trend line, which by the way goes back to the January lows on Apple. So that is a big break.
Gold prices weakened in the aftermath of U.S. inflation data on Thursday, reversing upside progress accumulated during the first 12 hours of the day. Headline CPI clocked in at 3.2% year-over-year in July against the 3.3% consensus, which was a little softer. But it marked an uptick from last month's 3% outcome. Meanwhile, the core gauge weakened slightly to 4.7% year-over-year from 4.8% as expected. Treasury yields aimed higher as well. A closer look at Federal Reserve monetary policy expectations reveals that while the report did little to alter near-term interest rate bets, the broader horizon looks a little bit different. The 3-plus-year horizon added the most tightening, which speaks to a central bank that is hawkish for longer. Let us now confirm with the video.
This chart on the yen, the dollar yen, we can clearly see that in October, the yen was up here, or the dollar yen was up here. All right, so huge move up. In October, the markets bottomed. It coincided with yields coming down and the dollar yen starting to come down. Well, now we've been same thing, starting to move up on the dollar yen. And what we can see here is that on a technical basis, we're now hitting resistance. But if this breaks, if this pivot high breaks through, you're likely going back to this level up here. So again, watch for that. Now, we know, again, the Japanese central bank has said, hey, we got to loosen yields because inflation is now running rampant. The cost of rice, or the price of rice, is starting to skyrocket. That's a major impactor on their food side of inflation. And again, we're seeing that inflation bubble up. And I've said this before, but when you have 250% debt to GDP, you're not in good shape for having higher yields. Think about the amount of interest payments if interest rates really pop. It's bad enough the U.S. is now paying basically $1 trillion a year. We only have in the U.S. about 130% debt to GDP, which, by the way, I say only like it's acceptable. It's ridiculous, all right? Absolutely ridiculous to carry that type of debt to GDP, but that's what we have. All right, so that's something to watch here. Now, let's take a look at a couple of the charts here. So I wanted to go over, let's go over the gold chart real quick, because gold initially this morning was up, but what we're seeing is gold struggling again. So this is a little bit of consolidation. The big factor for me is this pivot low here, this trend line. That's the key trend line, which is right around 1880. I do think gold's going to turn up in a strong manner here, but part of the reason why gold has been struggling is because we are seeing the dollar continue to stay strong. Remember, the dollar is still the best currency on a bad block. Doesn't matter how much debt the U.S. has. Right now, de-dollarization isn't a big thing. It could be starting, but it's not an impactful factor when people get scared. They still run back to king dollar. And what we can see here is the dollar's up again today, just like yesterday, and that's making it very hard for gold to really rally unless there's major fear in the market. Now, you could say there is major fear. No, there's not. There's not. And the reason you know there's not major fear in the market is because if you go to the VIX, which is the fear index, okay, here's the VIX. Let's zoom out. Okay, and I have a trend line on this here from a while back, but let me remove that right now. But basically, if we look at the VIX, you can clearly see this is no fear down here. Then you had, by the way, this is COVID, the spike in fear. This is the 2018 stock market collapse in 6 weeks that took place here. And look at where we are. We're basically in no fear zone. And so again, while I'm enlightening you and kind of putting you ahead of the curve in terms of being ready for what could be coming and alerting you to a 3% longer term, inflation number where the interest rates are probably going to be higher for longer, like the Fed has said, there's still the average investor is oblivious. The average investor is buying the dip, and that's telling us this as well. You've seen a little uptick recently, not enough to get anything exciting.
U.S. wholesale inflation rose more than expected in July, reversing a year-long cooling trend, the Bureau of Labor Statistics reported Friday. The Producer Price Index, which tracks the average change in prices that businesses pay to suppliers, rose 0.8% annually. That's above June's upwardly revised increase of 0.2% and higher than expectations for a 0.7% gain, according to consensus estimates on Refinitiv. Producer price hikes increased 0.3% from June to July, the highest monthly increase since January. PPI is a closely watched inflation gauge since it captures average price shifts before they reach consumers and is a proxy for potential price changes in stores. Services and demand for services were the primary culprits behind the lift higher for producer prices, said Kurt Rankin, senior economist for PNC Financial Services. Services prices rose 0.5% from June, the highest monthly increase since March 2022 for the category, BLS data shows. The inflation story now, be it for producers or consumers, is demand, he told CNN. Mainly that's consumers still spending money on services. The food index, which had declined for 3 straight months, rose 0.5% in July, suggesting a 6.3% annualized pace of inflation, he said. Consumers continue to go out and spend money, Rankin said. And as long as consumers are spending money, that's going to create demand from producers, so that's going to drive up their costs for their raw materials, for their transportation needs, etc. And they're going to pass those prices on to consumers, he added. That's an unpleasant cycle. The numbers over the past 6 months have been much more encouraging, but it's a reminder that the Federal Reserve has an eye toward the possibility of inflation flaring up again, he said. Do you agree with Gareth Soloway's analysis? Let us know in the comment section below. Also, don't forget to like, subscribe, and turn on notifications. Thanks for watching.